What if the next global financial collapse doesn't begin in a bank? Not in JPMorgan, not in Goldman Sachs, not in any institution we normally blame for recessions, crashes, or crises. Instead, imagine a failure that begins in the shadows, inside the companies we trust the most: BlackRock, Citadel, and Vanguard. They manage our pensions, they run our index funds, they execute nearly every stock trade we make. They shape the very structure of global markets. And yet they are not regulated like banks. They are larger than most countries, and they control something far more dangerous than deposits or loans. Control liquidity, the oxygen of financial markets. If liquidity disappears, even for a few hours, the entire global system freezes. This is the story of how that freeze could happen, why the trigger is already in motion, and how the world's most powerful financial institutions might accidentally set it off. But to understand this danger, we must go back to the moment when the financial system quietly changed forever. For most of modern history, banking was simple: take deposits, lend money, and obey strict regulations. Then came the 1970s and 80s, bringing three massive shifts: the deregulation of capital markets, new financial instruments, and the rise of asset management. While traditional banks faced tighter restrictions after every crisis, shadow banks, firms that act like banks but aren't regulated as banks, emerged to fill the gaps. Money market funds, hedge funds, and asset managers began offering credit, liquidity, and risk-taking, all without the burdens placed on older institutions. It was innovation. It was efficient, and it was mostly invisible. Among the early winners of this new world were three firms that would eventually dominate global finance: Vanguard, the creator of the index fund; BlackRock, the pioneer of modern risk management; and Citadel, a hedge fund and trading powerhouse. None of them intended to become shadow banks, but the system evolved around them and eventually became completely dependent on them. Let's start with Vanguard, the silent owner of corporate America. In the 1970s, Jack Bogle launched the index fund, allowing people to simply buy the market. It was easy, cheap, and reliable. Today, over half of U.S. equities are owned passively. Vanguard and BlackRock together hold about 20% of Apple, 17% of Microsoft, and 16% of JPMorgan. They hold significant stakes in most S&P 500 companies. This concentration is unprecedented. Two firms, structured as shadow banks, now have voting power over much of corporate America. But passive investing has a dangerous flaw. When money flows out, the funds must sell everything automatically. There's no human judgment, no selective selling. It's just mechanical liquidation that accelerates panic. Then there's BlackRock, powered by a $20 trillion algorithm. BlackRock began as a risk management company. Its founder, Larry Fink, built Aladdin, a risk engine so advanced it now analyzes global pension systems, insurance company portfolios, bank balance sheets, and even sovereign wealth funds. In total, over $20 trillion moves according to Aladdin's risk models. This means when Aladdin detects danger, when its models signal reduce exposure, institutions around the world react in unison. It's not a conspiracy, it's mechanical synchronization. And synchronized panic is the most dangerous kind. Finally, we have Citadel, the market maker behind your trades. Citadel is really two major entities: the extremely profitable hedge fund, and Citadel Securities, the market maker that executes around 40% of all U.S. retail stock trades. Ow! Every time a Robinhood user buys Tesla, or a Fidelity user sells Nvidia, Citadel is likely the one matching the trade. This provides essential liquidity in normal times. But during times of stress, it becomes a single point of failure. In 2020, and again during the 2021 meme stock mania, Citadel faced order flows so extreme that markets almost broke. If a market maker providing 40% of retail liquidity pauses, even briefly, the system can experience a financial heart attack. It's efficient, yes, but incredibly fragile. As these shadow banks grew, they became so large, interconnected, and essential that global markets now depend on them more than on traditional banks. And three massive risks emerged quietly beneath the surface. Risk number one is liquidity concentration. In the 1990s, liquidity came from hundreds of banks and firms. Today, it's concentrated in a handful: Citadel, BlackRock, Vanguard, State Street, and a few algorithmic firms. If any one of them stumbles, liquidity thins instantly. A pause of just a few minutes could trigger a cascade of collapsing prices. Risk number 2 is the private credit explosion. After 2008, banks reduced their risky lending. Shadow banks filled the void, creating the private credit industry. In 2010, it was a $300 billion market. Today, it's over $2.1 trillion. These are loans made to weaker companies, with no public reporting, no reserve requirements, and they're highly sensitive to interest rates. They are often locked in illiquid structures. This is the subprime mortgage bubble of the 2020s, only bigger and hidden in the dark. When defaults spike, the losses won't be known until the collapse is already in motion. And risk number 3 is the ETF liquidity illusion. ETFs promise instant liquidity, accurate pricing, and market tracking, but they rely on market makers, mostly Citadel, to maintain these illusions. In March 2020, bond ETFs broke. Their prices fell far below the value of the underlying assets. Investors panicked. Corporate debt markets froze. The Federal Reserve had to intervene, buying corporate bonds for the first time in history. And who was hired to run that program? BlackRock. The rescuer was also part of the cause. So how does the next collapse begin? Here is the most likely chain reaction. Step 1. Bond market volatility explodes. Interest rates rise, causing bond values to fall. Long-duration funds, pensions, and bond ETFs suffer steep losses. Outflows begin. Step 2. ETFs trigger forced selling. Passive funds have to rebalance automatically. They dump stocks and bonds indiscriminately. The selling accelerates and liquidity thins out. Step 3. Market makers pull back as volatility spikes. Citadel and other liquidity providers widen their spreads or simply reduce activity. Liquidity vanishes. Prices gap down violently. Step 4. Private credit blows up. Highly leveraged companies can't refinance their debt. Defaults skyrocket. Private credit funds freeze withdrawals or collapse entirely. Suddenly, all those hidden losses become visible. Step 5. The Aladdin chain reaction. BlackRock's risk engine flashes red. Funds across the globe reduce their risk exposure at the exact same time. A synchronized global sell-off begins. This is the core danger. Everyone reacts at once. Step 6. A systemic freeze. Liquidity disappears. Markets halt. Corporate funding evaporates. Money market funds break the buck. Banks can't roll over their short-term debt. The real economy slams into a wall. The disaster doesn't come from bankruptcies. It comes from the sudden disappearance of the financial system's oxygen, liquidity. When liquidity dries up, stocks collapse, bond markets seize, and corporate borrowing freezes. Real estate drops, businesses shut down, and governments scramble to respond. And here's the critical twist. The Fed can't easily bail out shadow banks. They don't take deposits. Hedge funds and ETFs don't have backstops. Private credit can't be recapitalized overnight, so it won't be a banking crisis. It will be a market infrastructure crisis, and a few people understand just how dangerous that is. History shows this same pattern repeating. In 1929, it was the unregulated investment trusts that controlled liquidity, until they collapsed under leverage. In 2008, it was subprime mortgages, where safe assets became toxic overnight. In 2020, we had the COVID liquidity freeze, where bond markets broke in days and shadow banks nearly collapsed. Each crisis grows faster, each bailout becomes bigger, and the underlying fragility only increases. So what are the takeaways? First, liquidity is the real fragility. Its concentration in a few shadow banks is the biggest systemic risk of our time. Second, passive investing turns violent in a crash. ETFs and index funds become forced sellers, accelerating downturns. And third, the next crisis will be much faster than 2008. Automation. Algorithms and synchronized models mean the system can break in hours, not months. BlackRock, Citadel, and Vanguard did not set out to become dangerous. They aren't villains, but they became the infrastructure of modern finance. And when infrastructure fails, everything fails. The next collapse won't begin with a bank failure. It will begin with something quieter, faster, and more deadly. The sudden disappearance of liquidity. By the time the world notices, The chain reaction will already be unstoppable. If you want more deep investigations into how the financial system really works, how crises form, how power concentrates, and how money moves behind the scenes, subscribe, like the video, and turn on notifications. There is much more to uncover. The story of the shadow bank explosion is only beginning.